You're taking a look at a live shot of the opening bells on Wall Street on this final full trading day of the holiday week. I'm Yahoo Finance Executive Editor Brian Sozzi, and this is Opening Bid. Here on Opening Bid, we bring you the investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with all that money you have. Let's get a quick check of what's hot in the markets here. Yahoo Finance senior reporter Brooke DePalma is live from the NASDAQ in Times Square. And Brooke, you're really locked in on all things Tesla off of these delivery numbers that just were a little disappointing here.
Just a little bit disappointing. What we're seeing with Tesla stock this morning is despite that 13% drop year over year from the Tesla Q2 deliveries when it comes to their vehicles, is despite that we're actually seeing Tesla shares move higher. They're up now roughly about more than 3%, almost 4%, moving higher in this very early opening hours of today's trading session. And that's largely because of the fact that albeit the Q2 deliveries dropped year over year, they did come in almost in line with what Wall Street had expected at 384,122 from April to June, that is, in this Q2 report. Now, if you take a closer look at that, we also know that this was higher than what we saw in the first quarter. And so Wall Street a bit optimistic about that. Another thing that our Laura Brannon pointed out in her reporting this morning was that the company also reported that it deployed a 9.6 gigawatts of energy storage products. That's up from 9.4 in the same quarter last year. So perhaps investors also optimistic about that now. Now, if we take a closer look at the major indices across the screen, we're seeing red this morning. Dow Jones Industrial opening slightly lower, NASDAQ opening slightly lower, also the S&P 500 moving slightly lower as well. We're really seeing, and if you take a closer look, what we're seeing here, when you look at the major sectors, we're seeing above, really what we saw more of an extension of yesterday. People really moving away from that riskier tech sector and moving perhaps into a bit more here of consumer staples, just a bit here. Also, if you take a closer look at another stock that I'm watching, that's Centene. And what we know there is the stock, let's take a closer look, it's moving far lower this morning. In pre-market trading, it was down roughly 33%. Now we're seeing that at market open. And what we know there is that it mostly operates Medicare and those Affordable Care Act insurance markets. And what we know there is that this company withdrew its financial 2025 earnings forecast. They said that essentially they expect a revenue hit of $1.8 billion in the second quarter. And that's largely because they expect their Medicare expenses in the second quarter to increase in key states like New York as well as Florida, particularly when it comes to behavioral health, home care, and drug spending expenses. And so that really is leaving major implications for what exactly this means for the overall healthcare insurance market as well. Once again, that stock down more than 30% in early hours trading here.
Yeah, Brooke, clearly investors plugged into that electric move in Tesla. Brooke, thanks so much. All right, we're firing things up with your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number one, suddenly jobs reports are one of the biggest drivers of the market. Why, you ask? Because how these numbers come in could be the difference in the Federal Reserve cutting or not cutting interest rates this year. The reads are confusing at best. The ADP employment report surprised today by showing employers cut 33,000 jobs in June. That may bolster rate cut expectations, but the JOLTS, or jobs opening report, was solid on Tuesday, and that caused traders to dial back their rate cut estimates. Talk about confusing. Number two, buying the losers. The third quarter has started with investors kicking the tires on the market's second quarter laggards. Is this the right call? We'll dive in. And number three, big changes could be coming for struggling Intel under new CEO Lip Bhutan. Whether they will be enough to reestablish the tech pioneer is wildly unknown. But here to break it all down, Argent Capital Management portfolio manager Jed Elbrook and Yahoo Finance senior reporters Inez Ferre and Brooke DePalma. Jed, let me start with you because the market is locked in on this disappointing ADP jobs report. But as I mentioned at the top, JOLTS report was somewhat solid. How important is the jobs report tomorrow? And if we get something worse than expected, where does the market go?
Yeah, it's really important. Like you said, the market's really fixated on the labor picture these days, given the implications for interest rates and all the speculation about rate cuts, coming up and when that might begin before year end. I think overall the labor picture is is stable overall. You pointed out some pluses, a couple negatives too, but overall, I think stability is the word, and that's allowed the Fed to be on hold most of this year, probably going to continue for the next couple months, and even when they do start to move, pretty modest size. Change.
So Jed, does stable mean no rate cuts this year? And if that's the case, where do you see rates going next year?
It wouldn't surprise me if rates aren't cut this year. On the other hand, maybe they will do 25 basis points or even 50. Just not big changes really either way. And then next year, yeah, I think that there will be some cuts. A lot of it swings on what kind of impact the tariffs have, and not just the actual tariffs, but the uncertainty it creates.
And as this has been a record-setting week for markets, you've got big tech hitting new records, not Amazon. We'll talk about that in the back half of the show. But here we have these jobs reports that are sending very confusing signs to investors. As you zoom out, does the economy, the data we're seeing, warrant stocks trading at these levels?
Well, look, I mean, I've been taking a look at where the commodity space is and what this is telling us about the broader economy. And if you take a look at what's happening right now, for example, oil down 10% year to date, this doesn't bode well as far as what if you're talking about greater demand because you've got a booming economy. This also has a lot to do with the supply side of things. You've got OPEC that's increasing supply, but Wall Street is expecting oil prices are going to come down, and they are going to stay around 67 for Brent this year, but then go lower even into the low 60s and 60 next year. So this is good on the inflationary part of things, and if you're talking about deflation. But if you look at other metals within the commodity space, those are soaring. You are looking at copper that's higher. You are looking at not just gold and silver, those precious metals, but you're also looking at palladium, platinum. And remember that copper, aluminum, platinum, these are used for construction. These are used for autos. These are used for onshoring. So that does say something about demand for onshoring, but this can also turn into a tale of larger inflation down the line.
Nez, I don't know if you remember, but I remember, and I'm just reflecting in real time on TV. I remember filling my mom's gas tank, $1 a gallon. I mean, this is what, late 80s, early 90s? I mean, are we going to go? We're not, late 90s, we're not going back to those levels.
No, we're not going back to the sub two per gallon, but we are going lower. We are trending lower, and you can expect to see gasoline going down below $3 a gallon by the end of the year. Several factors that are going into that, but over the last 3 years, we have seen gasoline prices trending lower.
All right,
below $2, though, that's a stretch.
All right, you heard it here first. That's why we ask these tough questions here on Opening Bid. Brooke, let me get over to you. As we said at the top of the show, not everything is hitting records in this market. There are laggards out there. One that caught my attention is Kava. Now, this is a name you covered on the IPO down at the New York Stock Exchange floor. You've talked to the CEO, Brett Schulman, many times. Why is that name, you think, been underperforming? To me, I mean, this is a company selling $10, $12, $13, $14, $15 bowls if you could get double protein. But I look at this ADP jobs report, I'm thinking maybe consumers are pulling back on all that stuff.
What we're really seeing there is this rundown from this all-time high of roughly $150 that we saw late last year as consumers really thought, how can I get the best bang for their buck? What's the best value here? After the company really had expanded so rapidly and got into new markets, what we really saw here was ultimately this move, this shift, where they had this rapid expansion and all these new consumers turning to Kava, and then essentially after that growth, we saw a bit of a slowdown, albeit not as much of a slowdown as other fast casual restaurants had seen. But once again, we are far off that all-time high that we saw last year. Shares now about $85 per share. And ultimately what we want to see here is we want to see that rapid expansion working in their favor. We want to see new consumers coming in. We want to see retention, and we really want to see that foot traffic continue to increase, albeit although these locations are open for a while here. We're seeing a bit of a tick move higher this morning after an upgrade from one analyst on the street, and certainly that's holding on to momentum into the early innings here.
Jeff, really, the reason why I bring this up, the first day of trading for this quarter yesterday, we saw a rotation into the laggards. I mean, some of the top performing stocks kick off this quarter were those stocks that did horribly in the second quarter. What is the play here? Do you put more money into those stocks hitting 52-week highs, or do you lighten the load there and pick up some losers from the second quarter?
Yeah, I think now's a good time to be bargain shopping. It's been a really extreme move in momentum stocks. That momentum factor in the markets has been exceptionally strong year to date. One of the strongest runs in the last 20 years, really. And then on the flip side of that, kind of traditional quality, high ROE, stable businesses have really performed poorly. And so I do expect, that obviously won't last forever. I do expect it'll shift. Don't know when. The flip in the quarter yesterday started that perhaps. But yeah, I think now is a good time to be looking for high quality businesses that have underperformed recently.
But these bargain plays, Jed, these are companies I would argue maybe not as fundamentally sound as some of the ones hitting 52-week highs. And I look at the Mag 7, those names have been red hot. I look at the bargain hunters. We're getting ready to hit earnings season in a few weeks. These are the companies maybe overly exposed to tariffs, could see earnings warnings, and now their stocks get hit.
Yeah. A lot of those fundamental factors you described do exist, but valuation also plays a role in market returns. And so I think we've seen one example, CrowdStrike. It's a wonderful business. It has risen to a valuation, that's extremely high, even for its trading history. While I think it'll remain an awesome business, maybe due for a breather.
Another story I'm watching here, team, is Intel. Off this Reuters report that new CEO Lip-Bu Tan may pull back on 18A manufacturing, may lean into new technology that may not be around until 2028. Our source tells me to expect big changes at Intel. I do expect those big changes to happen at Intel because the company cannot continue to lose large sums of money like it has been from its foundry business or that business that makes chips and it competes with Taiwan Semi. But you mentioned valuations here, Jed. Does anything about what Intel's doing interest you? This is a stock now trading almost in line with book value. We learned from Benjamin Graham. Once these stocks trade at book value or below book value, it could represent an opportunity, but Intel's really been struggling here.
Yeah, Intel's a perennial underperformer. We wouldn't, invest in that stock today. Most turnarounds do not succeed. I think Intel has a pretty tough future ahead of it, and they have extremely strong competition. You mentioned TSMC, really dominant, seemingly building on strength. Intel, pretty late in the game trying to turn around.
Yeah, I think ultimately Intel is a cost-cutting play into your end. But Brooke, let me get over to you because wildly different story. You have Intel shares trading at book value or how much their hard assets are worth, looking at potentially cutting costs and just doing everything or undoing everything that Pat Gelsinger, former CEO, did. But we're seeing strong results or strong gains in shares of NVIDIA, Qualcomm, and even AMD.
What a fall from grace NVIDIA has had over the past, the past year to date, or past year rather, shares are down more than 28%. And when you think about what exactly is moving here, where we're seeing those record highs, it is in the companies that are ultimately leading this AI revolution. And that is NVIDIA here. As we hear so many times from Wedbush analyst Dan Ives, really what we're seeing in NVIDIA is this revolution. Really what we're seeing is them leading the way, and others like Qualcomm, like AMD, looking to get on board, really developing their chip manufacturing business as well to get in on this AI revolution. What we've seen from Intel is really this fall behind. We know that we've heard from multiple sources that we have seen a change up in leadership there. Of course, we have a new CEO there in the past year. But when you take a look at NVIDIA hitting those record highs on Monday, it's certainly a far different story from Intel. NVIDIA's shares are now, as we make way into the opening trading, up roughly 1%. And what we saw on Monday was a record close. Perhaps they're regaining some of that momentum here as investors make their way into the shortened trading week.
Dan Ives certainly becoming a folk hero on the street. And Nez, imagine if he covered oil.
That would be amazing. If Dan Ives covered oil, I would just imagine the superlatives that he uses for oil. If he transfers what he does in tech to oil.
I'm going to drop him a text on that. All right, straight ahead, we'll have our stock of the day. It won't have anything to do with Dan Ives, but your clue is this. It has one big catalyst coming up in just a few short days. Stick around. Welcome back to Opening Bid. Let's get a quick look at the markets here on this Wednesday morning. This week is just flying by. Of course, holiday shortened trading week. Seeing some, muted action on the major indices. The Dow and the S&P 500 slightly negative. The NASDAQ in the positive. Of course, we had that disappointing ADP jobs report, so a 33,000 decline on the headline. Markets not really reacting. All right, it's time to fire up our stock of the day, and that is Amazon. I'm locked in on Amazon not because of the Jeff Bezos wedding aftermath, loving the photos out there, but because Prime Day is set to begin on July 8th. The shopping event will have one important change this year, which I view as a solid third quarter earnings catalyst for Amazon. Prime Day will last 96 hours, twice as long as last year. The longer shopping period could ring the register for Amazon. Bank of America estimates in a new note, Prime Day could haul in $21 billion in sales. Yes, that's correct, up 60% year over year. Despite this, I find one interesting thing when jumping onto the Yahoo Finance platform for some analysis. And analysts haven't hiked their EPS estimates on Amazon the last 90 days. In fact, they have fallen by 11 cents in the past 90 days. Still with me, my round table of pros, Brooke DePalma, Inez Ferre, and Jed Ellerbrook. Brooke, I'm going to go over to you because you cover consumer closely for us. A lot of other retailers, Walmart, Target, have tried to get some of Prime Day's turf in recent years, holding events of their own. But you heard the numbers there. This is going to be a big day for Amazon. Could it be a bad day for Walmart and Target?
Well, Walmart certainly looking to get in on the action. We now know that they're having a Walmart Deals event spanning the course of 6 days, starting at midnight on July 8th. And so Walmart's certainly thinking here, hey, this is not necessarily going to be a bad thing for us, but rather an opportunity here to really take market shares and continue to compete with Amazon, especially as Walmart looks to ramp up that key e-commerce business. Now, a far different story at Target. We know that Target has really struggled over the past year when it comes to that pullback in discretionary goods. Now, typically during this Prime Day event, let's be honest, sometimes we don't always buy those essentials. And so Target looking to get in on the action here. They're having a circle week from July 6th to July 12th. So not only are Walmart and Target looking to get in on the action, but they're saying, hey, we're having longer events for our most loyal customers here. And also something to note here is Amazon really using AI technology in this Prime Day event this year, and so it'll be interesting to see how Walmart and Target play into that too.
Brooke, right on. I don't need any more blenders. I got all the blenders I need. In fact, I just bought one for my desk here at Yahoo Finance HQ in New York City. I mean, I think it's great. It's a Shark Ninja blender. I can make smoothies in it. It's awesome. Jed, I want to get over to you. Yeah, it's really good. I'll show you. I mean, I sit right near you. Jed, I want to give her to you on Amazon stock. You know, we've been talking all morning long about stocks that have been doing well. Amazon stock, interestingly, down 8.5% from the January 27th highs. At the same time, other Mag 7 names like Meta, Nvidia hitting record highs. Is Amazon stock broken? And if so, why?
Yeah, no, it's not broken. Amazon stock has underperformed versus other Magnificent Seven names because Amazon is most exposed to the tariff uncertainty. And so I think the company guided conservatively for this upcoming second quarter earnings season. I think we'll see them beat that guidance here later this month. And as the tariff uncertainty fades, I think you'll see Amazon stock catch up. There's a lot of great stuff going on with their retail business, especially in their fulfillment network and the deployment of robots and just the additional retail sales and the leverage that provides them as they ship packages to people's homes. And then over on the cloud computing business, AWS, continued high, teens growth, which is outstanding. And I think there's room for that to improve further as they get more capacity online.
All right, let's get Jed, real quick. What people have forgotten that Prime Day sure rings up sales, but it's also an opportunity for them to get more Prime members. Is that the secret weapon of Amazon here on Prime Day?
Yeah, it is. It is. Once they get you in the network, in the system with Prime, it's really unusual for people to leave. The value of that Prime membership greatly exceeds its cost. And so Amazon continues to please customers and attract more and more every day.
I'm a very pleased Amazon customer. All right, it's time now for my question of the day. And it's actually two questions rolled into one because why not? Are there any under the radar signs the market is either ripe for more big gains or poised for a summer swoon? Of course, I still have my panel of super experts here. And let me go with you here. You're tracking something called the Golden Cross on the S&P 500. Why is that, and why does it matter to you?
Okay, and the golden cross is when the 50-day moving average moves above the 200-day moving average, and we have a chart to show you, and that's just happened. So this is a bullish sign. This is where the bulls are saying, see, we're going higher from here. Now, whether or not this translates into higher gains, have to see. But historically, when you do have a golden cross, you tend to see gains after that. It reinforces bullish momentum, but not always, because in 2023, 2 years ago, you saw a 9% drop after marking a golden cross. Now, but this is certainly a reversal from what we saw back in April, where we saw the death cross, and that was the 50-day moving average moving below the 200-day moving average. But look what happened after April. We saw a massive rally. Jared Blickery, our chart master, one time gave me this quote years ago, and he said, crossovers are great for long-term trend following, but if there's no trend, you get chopped up. So
that's really good. I will just quickly add, it's hard to top that one. My favorite market indicator, at least right now, I'm looking at the Hindenburg Omen. If you don't know what that is, I will tell you at Brian Sozzi on X. It's one of my things I just love to follow. I love the name. Brooke, I want to get back to you. You're looking at ADP, that report this morning, disappointing, and what it might signal to the economy and perhaps what it could signal for markets.
What we saw in this morning's ADP report was a job loss last month of 33,000 jobs. Of course, keep in mind, this was for the private sector. We'll get a better read on the larger economy from the Bureau of Labor Statistics tomorrow, because 4th of July is on Friday, and so they're sending out the report on Thursday morning this week. But what we really are looking into there is how many jobs were added, and ultimately the further implications of what this job loss, or rather what exactly this job gain hopefully will be, at least what economists expect per Bloomberg consensus data, that more than 100,000 jobs will be added. But we're really trying to understand, okay, what exactly does this then mean for the Federal Reserve? If jobs ultimately slow down, if companies are, as we saw with the ADP report, a little hesitant to hire right now, what exactly could this mean for the Federal Reserve's decision come July? Will they ultimately cut rates here? Also, we saw job growth, wage growth come in less than the last month, albeit higher. So what exactly does that mean ultimately when it comes to consumer spending power? So a lot of tea leaves that we're looking out for because of this job loss last month and what the implications could be come summer.
Jed, last word to you. Tell me you'll have something you're watching in the markets that suggests a summer swoon. I mean, there's a lot of hype out there in markets right now.
A delay in, so the 90-day pause on the tariffs and the trade war stuff is July 9th. If there are very few country announcements July 9th, and then we extend that window, say another 90 days, and we continue this period of uncertainty related to trade and tariffs, I think that would be an incremental headwind, especially for retailers, especially for industrial businesses, companies affected by the steel tariffs, etc.
Loving the clear-eyed analysis. Jed, Inez, Brooke, good to see you all. Talk to you soon. All right, coming up, Yahoo Finance's Market Catalyst. We bring you the news behind the biggest market moves for the trading day. Do stick around.